Good morning, everybody. It is Friday, December 27th, 2019. And today we are going to do our futile predictions for 2020 and the 1920s. In fact, the presentation isn't done yet. I'm going to answer some questions to people who are in the chat room and add those to the other predictions and thoughts for the new year. And then this will end up acting as a bit of a summary that we can work from, as many of these things end up not being true, and we'll have to adjust. So one of the most important parts of being a good investor is adjusting to how the markets change and how the economy changes and how circumstances have a way of working out differently than we thought maybe they would. So I am a little bit behind this week, and as I mentioned before the call, there's a good reason. I was hanging out at the hospital a little bit and, had Christmas as well. But I am now a grandfather at the ripe old age of 49. I guess that's what happens when everybody has babies in their early 20s in your family, including me. But yes, this is Dominic Hulk. Middle name is Hulk. So I am a Hulk Pa. I spent last night cooking, so I can take that over there. But yep, first grandkid and living right down the street, so should be fun. All right, let's move on to the futile predictions. So 2020, I have been talking about for about 2 years now, would be a potential down year in the market with the possibility for recession. But the phrase that you've heard me say most of all is a skip straight recession. So going all the way back to 2017, I was saying that the markets were not in euphoria. And this is something that I keep trotting out there, a conversation with Mark Yesko, where in July of 2017, I said the market was more in this enthusiasm range, and that in 2020, we'd probably end up in the delusion, or even possibly by 2019. The S&P 500 did in fact hit 3,000 with a SPY over 300. We're at about 3,200 right now. And I think that there is a clear setup for some volatility followed by a rally, and then that'll be your delusion and euphoria. So how does that look? Well, let's always remember, the more things change, the more we forget that change is the only constant. So my disclaimer here is, I could be wrong. But what about 2020? Well, we use the calendar as an artificial construct to gauge market performance. People believe that we are in a roaring bull market right now because stocks are at records and the S&P 500 is up around 30% this year. However, over the last 2 years, the stock market is only up 20%. How can that be? At the end of 2018, we had a heck of a correction in the fourth quarter. So the reality is that from here to here, it's only about a 20% gain or 10% annually. So that's about normal historically. It has been a historic decade though. Stocks, bonds, real estate assets have all appreciated substantially in the past decade, but the economy has not really reflected that growth. We've had pretty consistent GDP growth of around 2%, and that is after a massive decline in 2008 and 09. So I think we need to ask the reasons why the stock market, the real estate market, and the bond market have all done so well. And we will get to a chart here in just a moment where if it doesn't scream out at you danger, then probably you need to rethink things, because just as an alligator will snap down on you if you put your arm in its mouth, the stock market has similar constructs once in a while, and we are moving in on one. So here's the S&P 500 for the decade. This excludes a little bit of the rally after the Great Recession, but you can see it's been a heck of a ride. Only minor corrections, the biggest one being in 2018, and you'll notice that the corrections have gotten bigger the further along we've gone. So the corrections have gotten bigger every time. What does that portend for the future? Over the last decade, we can see QQQ has done the best. Your green line at the top, that's representative of the newer economy, the new blue chips, versus the S&P 500, which includes the NASDAQ 100, which is QQQ, but it also includes the 150 or 160 low growth, high debt stocks that I keep warning people about. So I actually believe, and here's a prediction that's not in the slideshow yet, I believe that the S&P 500 will not outpace inflation in the 2020s. Now, it will see an absolute gain because there will be inflation. However, I suspect that you're going to see over 100 companies in the S&P 500 not exist by the end of the decade. They'll either be absorbed, or in many cases, they will shrink to the point where they're kicked out of the index, or they may even go bankrupt. There will be dozens of companies that go to zero in the S&P 500 over the next decade. A combination of no growth, high debt, and just plain bad business adoption to the new economy, which is marked by sustainability and services and less input for more output. So companies that have the reverse equation, having to put a lot in to get a little out, are going to have a problem, especially companies that have to finance their operations. So here's the S&P 500 going back about 30 years. You can see that this is right around 1980. The market starts to rally hard on tax cuts and deficit spending under Ronald Reagan. We have the dot-com boom after a massive rally under Clinton. And then the crash, marked by a small recession. This is actually the scenario that I see most likely playing out. I see a small recession, or what I have termed a skip straight recession, in the next year or two, and possibly we can put it off several more years, but that's probably what's coming. The longer we put off a little bit of cleansing, a little bit of killing of the zombies, the more likely it becomes a financial crisis, which we got here. So we got the double top, the crisis, and then we broke resistance about 2013 or 14 this is. I'd have to double check. I think it was 2014. This is 2015, I believe. Yeah. So we break resistance 2013-14. We have the year of basically zero returns, and then the Trump rally. And I think we can fairly call this a Trump rally. Once again, just like the 80s, we see tax cuts for the rich and massive deficit spending to juice the economy. We have one big correction here. Will we get something like this or like this in the next year or two? The odds are rising that it will happen. I think that 2020 is a pretty good setup to get at least something this bad from 2018 and possibly worse. But I think that this level right here we see this level again. So keep an eye on this 240 mark, which is about where we got at the end of 2018. So here's your alligator. 20-year bond rates down and down and down and down. They're rebounding just a bit right now. And that got your TLT to go up and up and up and up. So you have this little bit of change here that probably doesn't accelerate much. There's support right about here. One of the trades that I'm going to recommend in our ETF portfolios is if this gets to the resistance line, this gets to a support line, probably want to add some TLT if we see volatility increasing. So how do we lay this out? Prediction 1. The S&P 500 will experience a bit of volatility early in the year. We are keeping an eye on the VIX, which just went over a 13 handle a few moments ago. That volatility mini correction sort of thing will be followed by a euphoric what-me rally into the late spring or early summer. And I think that the S&P 500 will peak near 3,600 by June-ish, and after President Trump is acquitted of impeachment charges. Now, I will say, what is interesting to me, and I talked about this last week, is that the Christian Times largely turned on President Trump last week. And that is the most influential evangelical publication. So there is the possibility that the Republicans decide that they don't want President Trump anymore because he doesn't stand much of a chance to win in the fall. I don't know. I think that there is a lot up in the air. There is in the range of a dozen Republican senators who pretty clearly could flip on President Trump. I don't see where 20 Republicans flip on President Trump, but stranger things have happened. And if they feel as if their jobs, right, if their jobs are in danger, then they might flip on him too. And the reason they could do that is if they think that there's a big wave of Democrats coming out in the fall to vote against President Trump, everybody down line on the ticket suffers from that if they're Republican. So the Republicans might say, you know, for me to win, I have to have President Trump off this ballot. Otherwise, he's going to drag me down. I'm not saying that that will happen. I won't put that on the prediction list, but it's a far greater possibility than is possible. Somebody decided that they thought they should say that the Christian Times editor is a lib. Who cares? Right? Does he automatically? He writes for the Christian Times. He's not that liberal. So the fact that he, you know, called out President Trump as the lead editorialist, Christianity Today, whichever one. Yeah, the other one is the Times, right? Post, Times, I get them mixed up. Christianity Today, yes. I showed that article last week. The evangelicals are a major voting bloc for President Trump. We already know that there's more never-Trumpers this time than last time from the private polling data. If the evangelicals aren't going to come out in full force for President Trump, I already don't think he has a very high chance of winning. But without the evangelicals, it's almost zero. So to the extent that that publication has influence, and we know that it does, as it goes to all the major leaders in the evangelical churches, it could have an impact. So we'll have to take a look. So now somebody's saying that that's not an evangelical magazine. It is the leading evangelical magazine. So Any case, prediction number one is that we get the what me worry rally. And the numbers that people are looking at that predict that President Trump will win are economic numbers. Couple of things here. I think that people are smarter today than they were 15 years ago. The last time we had a debt-driven rally, we got whacked. And your zero hedge crowd and everybody else is supposed to, on the conservative edge, is supposed to be against a debt-driven rally. So all the opinions that they've had economically don't really hold right now, but they're making an exception because it's their guy. And I think that that isn't going to play with the more centrist electorate. The center folks, the swing voters, the people like me who realize that this is dangerous to run $1 trillion, $1.5 trillion deficit on the back of tax cuts that we're really not seeing. I just don't think people are as into that, right, as they have been in the past. There's people who can see through this economy because they're not getting the benefits of it. Maybe they're just emotionally don't like it. But the reality is that the gains of this economy have fallen to relatively few. That's not new news. It's big news. And there's a lot of people reacting to that. So if those economic numbers turn, then your strategists of the world out east who are saying that, Trump has an 80% chance of winning based on the economics, that's backwards looking historical. It doesn't look at the boots on the ground today, who's actually going to vote and who's really buying into this economy. This is not a loved economy. And it's not a loved stock market rally. And that's probably the reason why I see the stock market really rallying into the middle of the year is I don't think everybody really expects that. I think a lot of people believe that, holy cow, we better start pulling in the sales. Well, we still have buybacks early on in the year. We still have a Fed that's pretty darn accommodating and pumping money onto their balance sheet right now. And most of that money going into the balance sheet of the Fed has to do with the repo market and making sure that nobody goes bust, making sure that we don't have a long-term capital moment or worse, a Lehman moment. That money really isn't finding its way into the markets and the economy. It's going to bank balance sheets to keep them secure. So again, this is my prediction. I think the SPY peaks around 3,600. So I've started to go through this. Prediction number 2. The economy is going to remain weak. GDP growth numbers are showing up as under 2%, most likely for the first quarter, going into the first quarter. I've said the first quarters are usually the bad quarters, just because of inventory cycles. I think that that'll hold true. The thing is, I don't see the second quarter having much of a rebound, and that'll take a toll at some point. So oil prices are going to stay relatively low in the 60s. They're doing everything they can in the Middle East to avoid having the war that I thought was coming. We have to adjust. If we're dogmatic, we'll lose. So I believe that probably by March or April, we get news out in the Middle East that there's some sort of détente. I think there is a good possibility that President Trump announces a light Iranian deal, right? So not a full-fledged nuclear arms deal, but some sort of pathway to a deal. That'll keep oil prices down. The Iranians, by the way, are only producing about 1 million barrels less than they were when all this started. So the idea that they're producing I think I've seen people say I've seen in the press, 4 million barrels a day less. That's not true. They're still producing it, they're still exporting it, but it's sitting in tankers and in storage tanks, mainly in China, without being put onto a ledger. They're just kind of being stored. No money's changing hands, or if it is, it's not finding its way into the accounting. We can track the tankers. We know the oil's moving. It's coming from Iran. So, there is no shortage of oil developing just yet. It'll take a Democratic president to tighten oil, which is what I've been saying for months and months and months now. So oil's going to stay relatively cheap this year unless there's some sort of war in the Middle East, which you certainly can't discount. But again, only the very best oil stocks are the ones to own. You don't want to own across the board. You have to own companies that have the good acreage in the Permian and have some other unaccounted for revenue stream. For example, who's using the new Kinder Morgan Permian pipeline? We know the answer to that. So companies like Pioneer are going to have extra revenue that they didn't have before, because now they can export their gas out of the Permian and get a little bit of money for it. Unemployment, we can see the signs, is likely to tick up, not by a lot, a couple of tenths of a percent, but it'll be a harbinger, it'll be a warning that potentially, as big companies start to cut payroll as they automate more, that there's a little bit of shock on the horizon. Andrew Yang? Whoever Yang is, the guy that's running for president, Yang, he talks about this coming. I don't think it's coming as fast as he thinks. I don't think automation is going to replace a third of our jobs in the next decade. I think that there will be new jobs. I think there will be different jobs. And because the baby boomers are retiring, that'll keep us from having a horrible unemployment problem. What does it look like in 20 or 30 years? Your guess is as good as mine. But once the millennials start to retire, that's a whole new shock to the system, because it's another huge wave of people retiring. So I don't see the horrible unemployment problems that other people see. I think the demographics insulate us a bit, and the new jobs that come from technology and technology-driven industries fill a lot of the gaps. Plus, clearly we need a lot more people in healthcare over the next 20, 30 years. And these won't be the highest skilled jobs, but there will be a big need for LPN level people. Your caretakers, your nurses' assistants, things like that. All of your technicians. So, rehab people, physical therapists. There's a lot of need for that. So it'll take people changing their jobs, but the jobs will be out there. Right now, we have a mismatch in the jobs market with, 4, 5, 6 million jobs available, and people aren't filling them because they don't have the training or the desire, one or the other. In any case, I believe that the market starts to soften because the economy starts to soften. Ultimately, the buyback bubble starts to wheeze as corporate earnings have a hard time keeping up with what they've done in the last couple of years. We know that the pensions and the retirement plans are continuing to sell as the boomers get older. That money's not getting reinvested. It generally goes into bonds. And the wealthy, and this is the linchpin, if the wealthy believe that President Trump is likely to lose, which means they're going to lose some tax breaks, they will start to sell en masse at some point. Once it becomes official, if he loses, the traders will pile on, and then you'll have your panic crowd. And since the market is driven by funds at the retail level, that becomes indiscriminate selling. For us, that could be pretty interesting, because then our very favorite stocks could get cheap, which is rare. I think that if President Trump loses, and looks like he's going to lose, the S&P 500 will end the year around 2,400. Right? This is a 2018 bottom. I believe we get there again. We get a double bottom. And off of that double bottom into the 2020s, we will get a heck of a rally. Something that looks like this again. But ultimately, we have a retirement crisis coming. So by the end of the 2020s, we have another major pullback, possibly a financial crisis, 2026, 27, 28, 29, somewhere in there. And the indexes will end up not beating the inflation rate. That means that the indexers are about to see another dead decade. So indexers from here to here, how well did they do? I believe we're about to see the same thing. So imagine that where we are right now is roughly this. And we'll get a correction, a long-term rally, and then another correction. I believe the 2020s will look like this box, generally. Just a higher gradient, higher range over here. That would be my prediction for the 2020s. Now, some more specific things. I'm going to be at the Consumer Electronics Show next week. And I'll get there next week, and then the show starts a couple days later. I'm covering things like artificial intelligence, the whole digital media and marketing systems, 5G, smart grid. Those are the things that I'm going to focus on for 5 days. And each day, I'm going to spend at one location for the most part. It might be one day where I do 2 locations. And I will put out an article that night. It'll first be on our services, margin of safety, investing, and fundamental trends, but they are going to appear for free on Seeking Alpha, and the title is going to be CES yesterday, and then it'll have a dash or a semicolon what I covered: artificial intelligence, digital media, 5G, smart grid, whatever the case may be. I'm laying out my agenda right now. It's pretty interesting. So in the 2020s, we should expect that the new and old economies to continue to diverge. I think that that is something that a lot of people still fight. I don't really understand why that is, but it is. You can see it in the comments on Seeking Alpha. People fight it over and over and over again. So far, here's my agenda at CES. I'm going to head over to Tech Trends to watch, and I'll check this out just to see if I can hang out with anybody cool. Going to do all the marketing on the digital Hollywood track, is what they're calling it. And in fact, I might have my girlfriend do this because she's a marketing person. So I might have her cover that. And then I'm going to go over to artificial intelligence. Tuesday is all about blockchain and cryptocurrency. If I could sneak over, I'm going to jump on over to the smart city grid, smart city track. So I have to sort this out, but ultimately the smart city is pretty important. The smart grid goes along with it. Talk about EVs and battery technology, different IoT. Again, like I said, I have to sort some of this out. There's certain things I can't make because I can't be in 2 places at one time. But I will be at CES, and a lot of this has been on my mind for a couple of years. At what point do these trends accelerate even more? And I think that it's important for us to realize that these trends towards more services, fewer inputs, more sustainability, more tech-driven, they're not going to slow down. Eventually, there'll be some legal issues, some policy issues to make sure that people get the benefit of this. You know, the other option would be we become a dystopian society, which I don't think anybody's real interested in. So as long as we avoid socialism and we avoid all the money going to just a few people, it should all work out. That doesn't mean that the stock market, the aggregate stock market, is going to do all that great. Just like there is a huge divide between QQQ and the S&P 500 over the last decade, I believe that divide will be greater in the next decade, with QQQ probably doing well and funds like the Innovation Fund from ARK doing well. But ultimately, this rise right here is going to be something that maybe S&P doesn't see because of those 100 to 150 slow growth, high debt companies petering out. So the S&P 500 is not where I want to be. QQQ, I want to buy on the dips. All right, let me go to a couple of questions. Somebody asked me, what do you think of Jeffrey Gundlach's prediction for a weak dollar in 2020? So here's the context for that. The dollar, I said back in 2012, would be the reserve currency for the rest of our lifetime. So way back in April of 2012, I told folks, so this is at the height of the whole dollar is going to collapse and we're not going to be the reserve currency. I told people that the dollar is going to be reserve currency for a very long time, for a lot of reasons that people overlook. And I gave a list of those reasons in here somewhere. There you go. And ultimately I said, because we're going to be energy independent, right? Energy is the one resource that probably gets cheaper and cheaper over time. It could spike in the early 2020s because policy could drive oil prices higher at the same time that we're getting rid of coal, and that solar and wind just aren't quite there yet for everybody. So there could be an adjustment period of several years. But ultimately, the dollar remains strong long term. Does that mean that we can have periods where the dollar weakens? Certainly. When we run these huge deficits and growth slows down, but we're in a generally good economy, the dollar can get weaker for a little while. But you have to remember why people want the dollar. We have the best geography on the planet. We have resources. We have a diversified economy that of the big economies, nobody's close to us. Nobody. Our GDP per capita destroys China's, destroys it. So while China, with 5 times more people, has about the same size of economy, we're 5 times more valuable economically than somebody in China. People need to keep that in mind, especially the little socialists running around out there who think that, well, China's doing it with a command economy, maybe it's not so bad, right? Go tell that to the people in Hong Kong. So it is okay to call a socialist an idiot because that's what they are. They're overlooking the realities of how people think and behave. And they think, well, nobody would ever take my rights away just because I want a socialist economy. Yeah, they would. That's what socialism really is. Command from a central authority. If you think it stops at the financial system, you're wrong. Doesn't stop until it gets all the way to your bedroom. Sometimes not even there. Sometimes in the operating room. Ask all the people who have been harvested for parts in China among the political prisoners. That's not a joke. So the United States is far and away of the big countries the best place to be in the world economically. And despite the idiocy of our infighting, probably the best place to be if you want to have freedom guaranteed for a long period of time. I'm not saying that Northern Europe isn't a great place. I'm just saying it's a little silly for people to think that it's utopia, given they made their money on oil and they've been taken over or run through every so often. It's not something that we have to worry about. We don't have to really worry about infringement of our borders. We don't really have to worry about losing massive amounts of income. They do. So keep an eye on these social movements out there because they impact the economy. But the reality is that the dollar is going to remain strong. And if you get a dip in 2020, which is very possible, you should buy dollar assets because the dollar will come roaring back for many, many, many reasons. The name of this article was Dollar Strength Beyond the Balance Sheet. It was actually the third in a series, I believe, in which the first two, I pointed out all the weaknesses in the dollar and how all the gold bugs and everybody was, I just outlined their ideas and people assumed that I supported them. And then I wrote this article and basically told them that they were all full of shit. Since then, the dollar's done nothing but go up. Has little breathers. So, is Gundlach's 1 year prediction a big deal? No. Could he be right? Yeah, probably. Would it last? No. I'm currently, somebody's asking, what's my cash percentage? For aggressive investors, about 40% cash. For conservative investors, about 75% cash. Now, the vast majority of my investors are kind of in the middle, and they're about 50% cash. So if you're aggressive, even you, I think, should be around 40% cash right now, just because I think we're about to get that volatility spike in a month or two. That's a trade that we'll look at doing again for those of you who do the swing trading over at fundamentaltrends.com. Everybody else, we're taking a look at TLT. I think that there's going to be an entry point for TLT. Why? Because the 20-year treasury is probably still going to go down lower a bit yet. So as it comes up, 1, 2, 3, 4, have to see how high it can get. As the treasury comes up, it's probably not a breaking point. And it probably heads down even lower. You'll see a treasury, 20-year treasury with a one handle again. And I think it'll be a low one handle, 1.2, 1.3, 1.4 at some point in the next decade. So these alligator jaws aren't ready to close, but there's going to be more volatility now as we get closer to having to deal with the retirement system crisis. And it is a crisis. There's just so many problems. You know, we're short $30 trillion on Social Security. And that doesn't mean that people won't get a Social Security check. Get that out of your head. Social Security is 70% funded to the end of the century. But in about 10 to 15 years, it's no longer 100% funded. So for a while yet, you know, we're 100% funded. But that could change pretty quickly because we are right at that just about even line. I think there's been months where there is fewer dollars coming in than going out. So as that becomes persistent, more dollars going out of Social Security than coming in, then we have a problem. That'll occur as the baby boomers continue to retire. And that's why I said 26, 7, 28, 29, 30, yeah, right in there. The second half of the 2020s, we're probably dealing with how do we solve the retirement system issue. The pension systems are somewhere between $4 and $6 trillion short. I have suggested we just print all the money for the retirement systems, put that money into lock boxes, invest it in U.S. treasuries, wipe out all that money that's coming off of the regular federal budget, the interest payments, and trickle that money into the economy for 30, 40 years. It would not be hyperinflationary because it's trickling in over a very long period of time. Solves a major debt issue without creating new debt. And that's a problem that we keep running into, is we keep creating more debt to get rid of debt. Eventually, that equation can't hold. And I think that the breaking point is 6, 7, 8 years from now. All right. Jeremy Grantham is forecasting emerging markets will outperform the U.S. stock markets for a long time due to lower valuation. Yes, but the emerging markets are more volatile. So this again goes towards my whole idea of avoid the middle of the market. Don't try to trade the middle of the market. Wait for extreme sell-offs. As the baby boomers retire around the world, and only in the United States is there really a young offset in the millennials, you're going to get more extreme events, especially because the central banks are going to have a hard time pushing on the string forever. There'll be more extremes. We're seeing it in this chart. We're seeing it in all of these charts. The extremes are more extreme, and they happen faster. So when we get a correction, look how sharp that was in the fourth quarter of last year. That's how it works now. So if you're an indexer, you can hold on. But what if you get a series of these for 7, 8 years? What if, oh, good grief, there it is. What if the 2020s look like the first 10 years of the 2000s? And this is what I do think it's going to look like. Just the box will be up here. So we have to differentiate where we want to invest. The indexers are going to have a very hard time in the next decade. Very hard time. And they're going to get frustrated. And you're going to see lots of people piling in the trading strategies because they went to a seminar and they got a system. When I was at the Traders Expo last January, I was amazed. One of the things that jumped out at me is that some of the best fundamental analysts in the world were there. And they couldn't fit rooms, right? They couldn't fill rooms with 60 seats. But if you were there to teach people options trading or technical trading or futures trading, you needed like 4 rooms with that divider in the middle pulled out, and you needed 400, 600 seats. The big sucking sound right now is to pull all the millennials into doing day trading and swing trading on a regular basis. If you want to swing trade, you have to swing trade against them. You wait for them to turn into a herd and stampede in a direction. And then, like Paul Tudor Jones, you find your opportunities at the turning points. And you have to measure your positions and scale in so that you can scale out later. And so that you don't have to be quite as precise in finding your turning points. But if you just want to be a trend trader and try to follow along with the herd, just understand that when the herd turns on you, you're dead meat, because you're never going to be in the front of that pack. You're always going to be behind the guys who started the trade with the bigger money. And when they turn around, they're probably not giving you a trade alert. Not right away anyway. So if you really want to do a risk managed approach to trading, which is what we're going to be doing in 2020, we've kind of been in beta here in 2019, but over at Fundamental Trends, we have swing trading. And it's not going to be a lot of trades. It's going to be when the trades pop up. We're looking for impact. We're not looking for, hey, I can make 75 trades and have an 80% success rate. What we're looking for is, I made several trades this year that really worked. And the ones that didn't work didn't cost me much. That's the approach that I'm going to take. Now, you can try to make lots and lots of trades. Try to say, look, I made a point there and I made a point there and I got 10 bips there. Have at it. At some point, you're going to hit one of these and you're going to think you're so smart for buying there, and you get that little rally, and then it's going to fall off a cliff. Remember the flash crash, what was it, 4 years ago now? Where you woke up and the market was limit down? More of those are coming. There will be limit down days. And that's why if you're an investor, you hold cash and you wait for those days. And the easiest security to have a limit order on is QQQ. And you just adjust it every week. Always put QQQ 20% lower, maybe 15% if you're going to be a little bit more aggressive, but in that 15 to 20% lower range of what it is today, of what it is this week. Because if we get a flash crash and the market's limit down and then the next day it follows through and you're down 15 or 20% in 2 or 3 days, and that is going to happen, I promise you, then you're buying QQQ right into the rally that's going to come right after that, because the trader's going to flip it. So avoid all that stuff in the middle. Wait for the things at the edges. Money flow that we talk about all the time gives us a pretty good signal, and relative strength index and MACD. And remember, you want to use those weekly and monthly charts, not just the daily charts. The daily charts are noise. I mean, that's kind of a tip off to what the weekly might do if it holds up. But the weekly charts and the monthly charts, that's how you find where your really good multi-month to a few year opportunities are. So the signal here, right? On Christmas Eve last year, I was telling everybody, buy. That was it. There was a signal there. And the market turned. We've got this big rally off the bottom. The next time this happens, we want to do the same thing. We want to come down and it's 3 waves, which is pretty typical, right? 3 waves. That's Elliott wave theory. Then you get your 5 waves up. 1, 2, 3, 4, 5. Are we at 5 right now? I would think that the count on Elliott wave is 1, 2, 3. And we're just in, and then there's minis inside. We get a correction, and then we get that wave up, right? I have a hard time with the Elliott wave reconciling where the 4th and 5th waves are going to be here. And I think just because of the shape of this, others are as well. So I just think you're going to have to decide which one of the waves is imperfect if you're doing an Elliott wave. Do you think Boeing's problems will continue into 2020? So I told everybody to stay away from Boeing quite a while ago. And the problem with them is that we don't know what the problem is, right? How bad is it over at Boeing? Let me see. All right. So I'm almost done with this. when I'm in Las Vegas, we'll do a show on the new list. So that'll be next week. What is that, the 3rd? They're in the Dow. Boeing's in the Dow Jones. People asked me when Boeing was over 400, how can I have my bullish support at 290 and the bottom fishing way down at 210? It'll never get down that low again. Well, suddenly we're pretty close to that 290. If we get the sell-off in the second half of the year that I'm talking about, Boeing could, in fact, go down to the lower 200s. It could have another 30% down. The problem, again, is we don't really know how fast they can right themselves. But we do know that they have they have a lot of orders that have been canceled. I forget who it was. Was it United Arab Emirates? Somebody just canceled an order on them. So I don't know to what extent they get beat up in the next year. They could be trending now. I haven't looked at the chart. They could be ready to bounce off of this lower level, this bullish support line. And for those of you who don't really follow along or aren't familiar or haven't heard this first support level is the one that we want to buy when there's generally an uptrend. The bottom fishing is what we want to wait for if we think there's a deeper correction coming, a correlated event of some sort, or if we think the company's in transition. Companies in transition often go all the way to the bottom fishing while the rest of the market doesn't. Boeing is a company in transition. So I think that lower 200s is very possible. Somebody asked about Exxon. They say on my XOP holding. Yeah, so I think that you want to get out of XOP. I've said this 100 times. I haven't owned XOP in quite a while. So that is the drilling, exploration and production oil and gas ETF. I don't like that ETF anymore. In fact, I don't even know that we have it listed anymore. But what I'd be looking at is QQQ and ARC Innovation on pullbacks. Again, I think we have quite a pullback coming yet. If you think the market is not going to have the giant sell-off that I see, then buy ARC Innovation at 44, and you might have to trade it. You might have to get out in the middle of the year, or you wait till the end of the year and 37. So it all depends on if you want to try to make that one swing trade this year, that one major asset allocation shift. I'm doing it with about half of my money, and the other half, like I said, I'm pretty fully in cash. I think there's a very good possibility that if we do see this market rally into the middle 3,000s, I could see myself being 75 cash across the board, by spring. Sell in May and go away might be a very real thing this year. All right. Any other questions, or should I babble a little bit and call it a day? Update your Tesla narrative. So I still think Tesla is going to 1,000 someday. However, they have had quite a run up, haven't they? And I think that Tesla's a hard stock to buy right now. I recommended selling it, starting to take profits. They got through their marijuana price, so everybody got a good laugh on that. Their earnings will not support this price for many years. Many years is a long time to keep the faith. And in the many year period, there's a lot of ups and downs. I think Tesla is a trading stock that you generally want to be long. I don't think that I will ever short Tesla, but I can definitely see getting rid of large hunks of my holdings like I just did. So all I have is a token position in Tesla at this moment. And I probably wouldn't buy it. And I've said I probably need to update these numbers, and in fact I am. That's actually what they're going to. I think I'd probably be a buyer of Tesla around 250. Unless for some reason it looked like because of the way that they're having the transition, right? They're in perpetual transition, that they were going to have a digger here. Now, here's the other thing to keep in mind, and I'm writing this article soon. I really think Tesla should buy GM. With their shares being this expensive right now, they could buy GM for half price. So Tesla buying GM is just the ultimate change the world transaction for a guy who wants to change the world. Apple. I think Apple is a great company, right? I mean, it is probably the #1 dividend growth stock. Here's the thing you have to remember about Apple. Berkshire Hathaway is selling it right now. So the problem with Apple is that in a correlated market correction, because people hold it as an individual stock and it's the #1 or 2 or 3 holding in a lot of ETFs, right, it'll get dumped because it's very liquid. The reason why Berkshire Hathaway has one of the reasons Berkshire Hathaway has a huge position in Apple is because it's very liquid for them. It is hard for Berkshire to get in and out of the market without changing the trajectory of a stock. So Apple, Berkshire sold 3 million shares earlier in the year, and they sold about 700 or 800 shares in the last quarter. And I believe that when their next report comes out, I would bet that Berkshire Hathaway has sold 3 or 4 million shares of Apple this quarter. So, I'm for sure not buying Apple here. Now, do I have to update my numbers? Yeah, I got to figure out what these really are. Is the bottom fishing now 180 and the bullish support somewhere in the 200s? Probably. But that's why I'm going through my entire list and creating new sheets. So we'll have the updated. When I get back from CES is when I'll release these, because then I can really focus on getting through them. I'd like to release them next week. I don't know. Maybe I just won't sleep for a week. We'll see. We've had a pretty good rally in the oil stocks. Pioneer is up $17, $18 in 2-3 weeks. Occidental hasn't done anything yet. Encana's come up a little bit. Devon's come up a little bit. Parsley's come up a little bit. I think if you want to be in oil, you stick with those very best companies. That's why you don't own XOP. You build yourself a mini portfolio of 5-6 oil stocks that you understand what their operations are, that you sat on their operations page, that you've gone and read their publications, and you understand those businesses. I think that there's a heck of a rally in the early 2020s in oil stocks, the good ones. A lot of companies are just going to tread water and fade away, right? They're going to be part of the companies that disappear in the next decade. So I don't want to own the whole spread of them. If you have a little bit of trade in you, you can own oil stocks. I think Exxon and Chevron have major falls coming at some point in the 2020s, because there's nobody to buy their assets. They're trying. There's nobody to buy their assets. The only oil major that I keep coming back to is Total. And that's because they're in utilities, and waste management, and solar, and battery storage, and everything else. And they don't do massive capital spending. They're notorious cheapskates. If they can't find an economic project, they don't do a new project. So, yeah, you know, they're deal with Apache down in next to Guyana. What is that? I forget which country that is. Yeah, it's not a great deal. It's just a good deal. The market is high right now, so there's not a lot of put selling ideas. You know, if you're going to go through companies to sell puts on, you know, you look for companies that have some color here. Occidental Petroleum is still there. Nutrien, Westlake Chemical. Oh no, I take that back. Cisco. Oh yeah, Cisco. I think you can sell puts on Cisco. Invesco. Public Storage. Sustainable growth stocks. I might even take iRobot off this list altogether. I haven't decided yet. I don't really want more than about 30 companies on these lists just because then they're not best ideas. I don't know if iRobot's going to make the cut. PTC, maybe, maybe not. Square, if your account's big enough to sell puts on Square. Xilinx, if your account is big enough to sell puts on Xilinx. You know, but yeah, remember, if we get an almost recession or a skip straight recession or just a general slowdown, or if things don't quite go well with China, right? Maybe that China deal isn't quite as good as people think. Semiconductors have a long way that they could go back down. I'm going to make a prediction here. Wasn't sure if I was going to say it. I think I'm going to. I believe that the entire Trump rally is going to go away. Potentially. So we take a look at on the S&P 500. We go back to December 2016. We'll even make it November, right? I said 240, but we could go all the way back down to 200 on the SPY. I've said 2200 is another number. There's a possibility that we wipe out this year most or all of the Trump rally. Think about that, especially this level right here. And what does that correspond to? Something that I've said over and over and over again. What is the long-term risk of the stock market? Right? It's an important chart that I put out quite a while ago. This line right in here, right around 220, down to 200 on the SPY. That's a pretty big support level. Do we get all the way down there? I don't know. I think right in here is where we get. But we could see the entire Trump rally wiped out. How could that happen? There's going to be a lot of angry people if he loses. I don't know how much money they have, but enough. There's rich people, plenty of rich Republicans. They might, you know, if they're guided by ideology with their investments, and some of them are, you could see the sell-off get even worse. To me, that's an even bigger opportunity because I am heavy in cash. So we'll see. I think end phase ultimately breaks 60 in the next couple of years. I think it goes through. So will it get back down to here? I don't know. But I think right in here, for sure, you gotta be buying it. 24, 25, 26. I've said that a few times. How much do you want to quibble over a couple of dollars? Sell puts on end phase. You know, put in a limit order for a $24 or $25 put and to get a buck. You know, we could actually call it the trusty Yahoo. Okay. Let's take a look at those February puts. On a $25 end phase February put, I get $1.50. Net cost $23.50 to get into end phase. I don't know. I think that's a pretty good deal. Then hold a little cash to be able to buy it if it gets back down into here. There you go. I think end phase. So think about what's going on in California. They build almost 100,000 homes per year in California. And they're all going to be required just about to have solar energy. End phase is the prohibitive favorite in that type of solar. Now, big projects with wires, solar edge. But smaller residential projects, that's end phase because they just snap in. So, you know, you have to understand how each of their products are configured. Their end phase is better for the smaller to mid-sized projects, and solar edge is better for the mid-sized to large projects, right? So there's a crossover. The commercial is where the fighting is. And there I like SunPower. All right. Yeah. Yeah, we bought end phase just under 20. Or right at 20. All right, I think that's going to do it. I'm going to write a couple more articles. I got like 5 articles coming out this week. And I think the bottom line is there's a lot of uncertainty in 2020. You need exposure to the market because nobody's going to divine it perfectly. However, when we take a look at different signals, right? We take a look at money flow, take a look at MACD, and we just simple stuff. We don't have to have anything exotic. In the very short run, you know, we got an RSI 77 for the S&P 500. You know, and money flow has already started to come down. This is called a negative divergence. You should be selling into this strength if you need to raise more cash. You flip this to the weekly chart. That's even overbought. Money flow starting to turn over. And I had probably jitterbug for a while. MACD, can't quite see it there, but it looks like that's going to level off. Go to the monthly chart, right? RSI is oversold. When this number gets over 70, watch out. And that's going to happen in January. So this money flow, probably still going to hang on a little bit because of the retirement plan money in January. I think you got a couple of weeks to really be a good seller, but the trader 50 Cent, who is hedging something big, I don't think he's just a speculator, just started buying a lot of volatility calls. I don't want to buy volatility calls on a good setup. We bought a good setup a while back and basically broke even after put premiums were included. I want great setups to take something so high risk. Volatility trades are super high risk. I don't want to do it unless I get the perfect setup. Let's take a look at volatility here and we'll finish up. Remember, with volatility, we're looking for numbers down close to the 10. Want a 10 handle. Lately, 12 handles have been more common. So volatility has ticked up just a little bit lately. I think if we get one more dip down here, get underneath this level, underneath where we were a couple months ago, then I think there's a shot for a volatility trade. But again, I'm very picky. I don't like to do these unless they're way down here. And what if volatility does head all the way down to 10 again? This was the best trade we ever made right here for volatility. And we bought volatility right here and just killed it. Those trades are few and far between. And they're higher risk the higher up you start. So, I would just as soon avoid this trade until I think there's an almost perfect setup. Somebody's asking for a QQQ technical chart. All right, this will be the last one because this is my favorite index. QQQ is overbought, led primarily by Apple. Remember, I don't know when the 13Fs come out. I'm telling you right now, Berkshire Hathaway is selling Apple stock into this rally. It's going to wake people up when they realize that it was 3-4 million shares. Negative divergence, money flows coming down while the market's going up. That screams out you should be selling into the strength every single time. Again, money flow turning over on the weekly. Market keeps screaming up. Negative divergence. You should be a seller. That's all there is to it. You should be a seller. I think you got a week or two. And I would just as soon sell now. Today's kind of a flat day. Maybe you wait for one more up day on Monday or Tuesday. But, manage your risk. Don't try to guess what the market's going to do. Always think to yourself, and this should be one of your resolutions as an investor. Always think to yourself, what do I lose if something goes against me? What do I lose if I don't do something that I should do from a risk management standpoint? And if you're buying stocks, I implore you, read the freaking corporate material. I'm reading it all, but I don't know what each one of you feels about risk. You need to have enough background knowledge on companies that you can intelligently make a buy or sell decision, not just based on what I say. So I'm giving you some good ideas and I think a general pathway, but only you can manage your risk. And that should be the number one thing on your agenda all the time. Manage your risk. The gains will take care of themselves if you manage your risk. Buffett talks about it all the time. You don't need more risk to make more gain. Avoid deep losses. And again, I say that as somebody who's not always been able to pull it off. The oil kicked me in the butt. Work on avoiding big losses. Stay away from the middle of the market. Think about your risk first. and understand the industries and the companies that you're invested in. Do they really have growth that underlies their dividend, their buyback, their R&D? Are they doing something that gives them a durable competitive advantage? And when you break it down to those simplicities, all this stuff just becomes the guideposts in the road. Make sure you're on the right roads. So again, I think if you haven't increased your cash positions yet, you need to be doing it. And then the easy trade is a set a buy order for this, for QQQ, down around 175. I think my orders might be at 170, but in that range. You just see where the line is, right? Start curving up here in August. This line right here, boom, there's a point, right around 175. So I want to buy QQQ around 175, 170, right in there. And I really want to buy it down here, 140-ish. But I want to like borrow money from somebody if it gets all the way down to 120-ish. And if it gets way down here to 110, 115, borrow more money. But this is what I'm looking for. I think this is very probable. Below here is improbable, but could happen. All right, that's it. I will finish this presentation this week. I got a bunch of it started. But this is an important chart. How much of this rally can we give back? Because this is rather irrational. And it doesn't smell of the euphoria that people believe. It's kind of been stretched out and supported by easy money. This is clearly something to worry about. And this could happen. Sorry that 2020 could be a bummer, but it should be interesting. And if you make it to Milwaukee for the Democratic National Convention, I'm trying to get in there because I just want to see how it happens. Even though, as I've said, I don't think there's a party out there that has a home for me. But, you know, I try the best to call them as I see them. And I know the people are mad at me for suggesting that President Trump's probably going to get waxed at the end of the year. But I'm just relying on that private polling data and the fact that he's having a bit of a fallout with some of the evangelicals. It's a big deal. It doesn't take a lot to swing an election. And he's starting from 3 million votes behind, right? 78,000 votes got on the 4 swing states that made the difference. You know, I just think it's going to be a very tough run for him, given that Democrats have been turning out in you know, non-presidential elections all over the country. So keep that in mind. And remember that the United States keeps doing well because it's the United States. We can put almost any schmuck in there. And at some point, we rally off of whatever they screw up. And that'll happen again. So if we get the great big pullback at the end of the year, you should be a buyer because it's the United States of America. I'll finish on that. Have a great weekend, everybody.